lesson they've all learned.
That's right. That's what I've heard of it. Yeah,
in the public eye.
I don't know how good that is, but I thought it was quite, a lot of people... Okay. And I also have their slide.
Okay.
Okay.
Good afternoon, everyone. Good afternoon, and welcome. Some of you are very familiar faces from the session we had 2 hours ago. And some of you are very familiar faces from the breakfast session with Ian and Jared this morning. So here we are again talking about banking, an ever interesting subject. And the question we're going to try and discuss this evening is the complex ethics of banking. Who gets the blame? Now, for those of you who were at the last session that we all took part in 2 hours ago, we've done blame pretty much. We named the guilty men, and 2 hours later they are still guilty. So I don't really see a lot of reason to go over that ground again, but then I'm not going to stop you asking whatever questions you want to ask when we get to the question and answer session. But the question of what is an ethical bank and what is ethical banking is becoming much more pertinent, it's becoming much more of a political issue, it's becoming much more of an issue that bank boards have to take account of, and it is not an easy question to answer, which is the principal reason that I'm going to ask the question, but I'm not going to answer it. I mean, instead, I'm going to ask our panelists here, Philip Augar, author of both a book on banking, on Barclays, but also more recently on a banker who tried to fake his own death. Jared Biebler, who memorably has written the definitive book on the collapse of the Icelandic banks, and Ian Fraser, who's written the definitive book on the collapse of RBS, the biggest banking failure in British history. So I'm going to put to them each this question. If we could find an ethical bank, what would it look like? What would it be? Jared, would you like to start with that?
Okay. Thanks. Well, I was thinking about this in the break, and I would say two things. The first is my age-old, those of you who have heard me speak or talk before, my age-old saw about incentives. And in this case, if we wanted to take a currently existing bank and make it ethical, the question I would ask is, who in that organization gets paid or gets a bonus when they stop an unethical deal? Who gets paid, because in no bank that I know of does the risk manager actually get a bonus for stopping a risk. Usually they are expected to wave risks through. So that's the first piece. But the second thing I'd like to introduce is the idea of limited purpose banking. I'm not an expert on this. This is Lawrence Kotlikoff. Has a nice series of articles about this, and he has a book called Jimmy Stewart is Dead. And this concept he introduced after the global financial crisis. And the idea is that in the Great Recession, 60% of the houses were built of straw, but 40% were built of brick. And the ones built of brick were the investment funds, the fully financed mutual funds. And it would be possible to actually structure a financial system 100% built on these funds. And then you would not need to worry about ethics because you'd have, in his concept, you have, government sanctioned but privately paid ratings organizations that rate these funds. And they get paid, I think they get paid out of the regulator. Again, I'm not an expert on this, but I think it's a really interesting idea. And I know that he presented at the Bank of England. Mervyn King invited him in, I think, 2010 or 2011. And there was a lot of talk about this. But then, of course, as 2008 faded into the rearview mirror, people forgot, and the bankers, incentivized or wanted things to be kept the way they were. But after the Credit Suisse collapse last year, he was again in the news, and again with this idea of limited purpose banking, which I think is really pretty fascinating. So I would leave it there, I think.
Good, thank you. We'll come back to that. Ian, what does the perfect ethical bank look like?
I mean, I think that this what Jared's talking about is the same as full reserve banking, isn't it? So you have basically a much stronger capital base, so which restrains your ability to make reckless loans, and perhaps enhances your desire to make sensible loans, which are more likely to be repaid. I mean, I really don't know what an ethical bank a truly ethical bank would look like. But there are one or two examples, like Handelsbanken in Sweden, which has a big presence now in the UK, which does not pay any of its staff a bonus for selling things. So that automatically improves behavior. If you're going to reward people with bonuses for selling products, and they often won't care if that thing will destroy the borrower within weeks or hours or days, that obviously encourages bad behavior, lack of prudence, recklessness, and ultimately collapse. So the Handelsbanken model of not paying bonuses, I think, is a good starting point, because the incentives in banking are everything. The Triodos model is quite interesting. Like that vets every borrower to ensure that it's got a properly sustainable agenda. I personally have some issues with Triodos because they use RBS as their platform. And RBS is not my favorite bank, it's now called NatWest. But what they're doing is interesting. Co-op Bank was like that until it was taken over by hedge funds. So there are there are certain pockets. What was it? The Airdrie Savings Bank was an example of a prudent, well-managed, safe bank, but that's unfortunately failed, hasn't it? But I think a lot of it's to do with the incentives.
Good. Philip, what does an ethical bank look like?
Good question. Good question. And I'll get onto that in just a minute, Ray, if I can. But I wanted to start off with a story about what an ethical bank doesn't look like. And it's a story I want to take from the book I did on Barclays. It's the bank that lived a little. And I want to pick out from this book a story I told about a Barclays client, and it happens to be a Barclays client. I know this story really well, but it could have been actually any of the banks, and it still could be. So it's about a man called Carl, who grows up in the 70s and 80s, living on one of the roughest housing estates in Glasgow. Drug dealing and crime and gun running are basically what teenagers in that estate do. But Carl is different. He's really interested in music, house music, and he gets a job at the local ice rink, playing the records for the kids to dance to. And he plays the standard tunes of the 80s and early 90s. But at the end of the session, he plays a few house records that he's imported from America and Europe. And at the end of the session, the kids all come up and say, that music was great, where do you get that from? And Carl, who doesn't want to do drugs and doesn't want to sell guns, he thinks, okay, I could start a business here. So he starts to import these records from Europe, and he sells them out of the spare bedroom in his parents' council house. Business goes well. Eventually decides that he can rent some warehouse space. That goes really well. So he decides now that, and it's going so well that he needs a bank to work with him. And the nearest bank happens to be a Barclays bank, so he opens an account with Barclays. These were in the days when you could open a bank account quite easily. If you're a small business, you can't anymore. So that goes pretty well. Business builds and builds and builds, and he decides actually he can now buy a warehouse. But he needs a mortgage. Where do you go? Of course he goes to Barclays. They like him by now. They give him a relationship manager. Relationship manager facilitates a mortgage for him. Everything is going really well. The business is building nicely. Carl needs a bit of help occasionally if bills need paying. Bank ring him helpfully if they say and tell him that you've got too much cash in your current account, spread it across here. It's all going really well. So well, actually, that he decides he needs a bigger mortgage and he needs a bigger warehouse, he needs a second mortgage. Relationship manager comes back in, but this time he's got a second person with him. Carly says, this is Carol. She's part of the team. That's not actually true, because the relationship manager works for Barclays Bank. Carol works for Barclays Capital, the investment bank. And she runs through a presentation for Carl, which says that, if you're taking out a mortgage this size, what are you going to do if interest rates go up? Will your business be able to manage? Carl says, yeah, that's fine. I've got loads of cash. I'll be fine. No, she says, most of our clients do this, and it means if interest rates go up, not only are you covered, but you can actually make money from it. It's fantastic. Carl looks across at the relationship manager, who nods, and he signs up for this. And it all goes along fine for a few years. Anyway, eventually, he sees interest rates sort of bubbling along the bottom like that, and monthly statements come in, and then interest rates start to fall. And he sees on his quarterly bank statement a line derivatives charges. What's that, his finance director says. Carl says, I'll just ring Barclays, they'll tell me. Eventually, after a lot of difficulty in getting through to Barclays, they say, well, actually, you bought this interest rate product from us, and you know you're protected if interest rates go up, but if interest rates go down, you have to pay us. So Carl says, no one ever explained that to me. I didn't understand that. That wasn't the advice you gave me. And Barclays said, you were never given any advice. Carl is a smart man. He says, well, why was Carol working for a business called Financial Advisory? Bit of a silence. Anyway, there's a terrible battle ensues. Barclays stopped returning his calls. He can't get through anymore. Finally, he gets through to a risk manager and says, listen, son, you made a bet, you lost. Carl says, I didn't even know I was in the betting shop. Now, I looked into this when writing this book, and it turns out, not surprisingly, that Carol is heavily incentivized to sell the product. And is she to blame? We don't want to get into the blame game again. But the incentive structure is clearly wrong there. Above Carol's head, the risk department have clearly been told, say no to client restitution. That order then comes from, presumably, the top management of that division, which in turn comes from the board. Why do the board get into this issue? Why are the board driving profit right through the organization? And this could be any bank, it's not just, could easily, not just Barclays. The reason they are is that they've subscribed to the notion of shareholder value. And I think that in the last quarter of the 20th century, banking moved from an industry where unethical behavior happened, but it was spasmodic, and it wasn't institutional, and it wasn't structural. We moved to a situation in the last quarter of the 20th century when the notion that businesses run primarily for the shareholder, above the interests of customers and employees, that took hold. And we moved into the era initially pioneered by a manager called Brian Pittman at Lloyd's, where bankers were told to upsell and cross-sell. Just as when you go to the cinema and buy your cinema ticket, they try and sell you some popcorn and some Diet Coke, because that's where the margin is. And from that moment, we're into the mess that we've been talking about all day. So to get back finally, Ray, sorry, it's a long answer to a very simple question. It's a bank where people don't upsell, where people don't cross-sell, where the incentives are not aligned to profit, they're aligned to quality of call, customer service in the general way, and where shareholder value is taken not to be this quarter's share price or this year's results, but the long-term performance of the shares, the long-term interests of customers, employees, the bank itself, and the economy at large.
So if we have a bank that doesn't swindle its customers, is that sufficient? Is that an ethical bank?
It's a big start, isn't it? I mean, actually, yes, it's a simple question. Is it asking that much, you know? Does Haycastle swindle its customers? I doubt it, because it's an ethical organisation. It's not profit-driven. The people that run the Haycastle Trust aren't, I imagine, they're not on incentive payments. They're under no pressure to make, you know, bigger entrance fees. Yeah, that's not a bad basis to run a business.
Okay, so we start from there. We've got this bank that is fair to its customers. And one of its customers is a heavily polluting petrochemical company. Does the bank have any ethical or moral duty to try to limit the damage that that company does to the environment and to society, or not?
Is that question to me or to the panel?
It's a question that you can start with, and then we'll move on.
It does, because the bank has, I mean, a responsible business has duties to its customers, to its staff, and to the widest, the ecosystem in the widest sense, the financial ecosystem, the natural ecosystem, to humanity, to civilization at large. That's the whole point about. And I think actually that's how shareholder value was originally conceived. It's in the broadest sense. It got seized by the consultants in the 1980s into something different. But yes, it has all of those things.
Jared, the Icelandic banks obviously did damage to their customers and and ultimately to their shareholders, but they also did damage to society generally in Iceland.
Yep.
Would that be part of the ethical duty of a bank to look to the wider society and its impact and beyond its duty to its customers and its shareholders?
Yeah, because we have, as a society, we have entrusted banks to provide us our social plumbing. You know, I mean, you said earlier, if you lose your bank card, you're lost for a couple of days.
Yeah.
And I love that quote. I mean, I wrote it down here, but
I give it to you without royalties attached to it.
Thank you. And you know, yes, we rely on them to keep the machinery of society running.
Yeah.
And therefore, they have a responsibility. I did a talk in what was that, September last year, for an organization called Swiss Sustainable Finance in Zurich. And they wanted me to talk about sustainable finance, and I shocked them a bit because I don't have it here, but I had a nice picture of all the things that the financial system provides for us, like payments, like current accounts, investment funds, retirement, mortgages, all those things. And I said, if our financial system isn't doing these things sustainably first, then let's talk about those first, and then let's talk about loaning to polluters and so on. But even just the mechanics need to be sustainable, meaning that they need to last for decades. And I said, right now, it's not that way. And they didn't like that, because they wanted me to talk about green finance, I think. But anyway, yeah.
Ian, the UN wants banks to practice responsible banking, which goes a lot further than just not financing polluters. There are lots of environmental aspects to that, but also human rights and how we treat our fellow man and how we fund regimes. Do you think banks should be asked to go into those areas, or is that beyond their competence?
I think it's probably asking too much of the banks, you know, to be the arbiters of morality and behavior. I think, considering they're at the opposite end of the spectrum right now, they're in many ways, you know, promoting or encouraging things like money laundering for dictators and despots from other regimes. You know, Coutts, which is a subsidiary of NatWest, has been very heavily implicated in that game for many years. But I think actually Martin Wolf's quite good on this. And Martin Wolf wrote several pieces at around the time of Silicon Valley Bank collapsed in March 2023, last year. So exactly a year ago, we had a series of bank collapses, which included Silicon Valley Bank, Signature, Credit Suisse in Switzerland, and First Republic in California. And he wrote several good articles around that time. And what he said was banks are wards of the state because they are at the heart of the credit system. But even more, because their deposit liabilities are so politically important. The marriage of risky and often illiquid assets with liabilities that have to be safe and liquid within undercapitalized, profit-seeking and bonus-paying institutions regulated by politically subservient and often incompetent public sectors, referring to things like the FCA there, is a calamity waiting to happen. Banking needs radical change. So there are some serious issues around this, around the ethics of banking and the fact that it has the moral hazard of as a kind of backstop. It knows that in this crisis, a too-big-to-fail bank will be saved by the taxpayer or by the central bank or by both. And he has outlined various ways of resolving this issue with banking, which is, increasing the robustness of banks. It's not that difficult.
We had, after the 2008 crash, we had a proposal to separate entirely the retail arms of banks and their, what we might pejoratively call casino banking activities, which was progressively watered down under serious lobbying by the banks, to the extent that, well, what is the extent, Philip? Are banks still using their balance sheet strength derived from ordinary savers to gamble on the money markets?
Well, no. In the UK, and it is only in the UK, retail banks have to be completely ring-fenced from the investment bank. However, retail banks do use money markets to play the interest rate cycle. So if you think that a ring-fenced retail bank is absolutely just safe as houses and is effectively doing low-risk kind of fractional banking, that's not quite right. We had results from Barclays last week, and it reveals that they're making £2 to £3 billion a year from this interest rate smoothing. It's still risky. But may I just, while I've got the microphone, just pick up a second, because there was a period after the financial crisis when business in particular, and especially banks, acknowledged their wider responsibilities to society. The American Business Roundtable sent out a grand letter. I think Jamie Dimon, the chairman and CEO of JP Morgan, was the chair of that organization. He led it, he signed it. This was 3 or 4 years ago. But I mean, since then, bit by bit, this is just being gradually unpicked. Institutions are walking back from their ESG responsibilities, and you just have to keep them. You have to keep them at it, and at it. If you're a journalist or a member of the public or a shareholder interested in these things, because the minute you let off the pressure, it slips back to some form of the shareholder value model that I described earlier.
Can I say something on that?
Sure.
I mean, you have got a government at the moment which isn't really doing that sort of thing. It's not encouraged. It probably thinks it's too woke to challenge the banks on things like ESG. And Labour, you might have thought, would have actually had a slightly more, interventionist approach as far as finance was concerned. But under the present leader, Keir Starmer, they're basically cozying up to the banking sector and emulating pretty much what Gordon Brown and Tony Blair did in '97, of saying, we are your friends, we'll do what you want. And I think that is pretty worrying. Lloyd's, for example, is sponsoring various events for the Labour Party.
Do you want to say it?
And Lloyd's is also providing assistance to various people, including the Shadow Business Secretary. So the Shadow Business's main assistant is employed by Lloyd's Banking Group. What does that mean that that assistant, that person who's advising him on policy, will advise Jonathan Reynolds on anything radical to do with the city or finance? Probably not.
Let's open it to questions at that point. I always say, there's always a silence when you open it to questions, and no hands go up. And I remember being on a panel where Richard Branson was a panel member, and the chair said, any question, there was silence. Branson said, 2 free tickets to New York for the first person to ask a question. And I wasn't quick enough, the forest of hands went. So we've got 2 at the front here, and I'll work my way back, but we've got 2 at the front, and then 1 in the second row there. We'll take those 3 first.
Do these guys get the free tickets to New York, the first 2, or is
at your expense.
Thank you, yeah.
I'd like to take it from the other angle. I don't know. It's hopeless with the blame, and there's always somebody that's going to be pursuing greed, so why not turn it back on them? Was there ever a time in banking when the banks weren't limited liability corporations, but partnerships? Might that stop or restrain it somewhat so that what they're after the most, money, would be on the line for them if they misbehave?
Yeah. Well, I've actually...
No, hang on,
okay,
let's have
sorry.
3 questions. Yes.
3.
I'd like to question this idea of banks being responsible for like greater social, responsibilities, etc. If you look at, say, an industry like the drug industry, the illegal drug industry, the Sinaloa cartel is not exactly being financed by the banking industry, and yet it prevails, right? So is it actually going to help society at all if we force banks to make ESG judgments that constrain lending to polluters, etc., when reality shows us that it hasn't stopped the drug market?
Okay, and a third question. No, it's at the front here, just in the second row. Then I'll work my way back.
May I put forward the claim of Unity Trust Bank, which is trade union owned, to be an ethical bank, having been there at the beginning, and also at the same time say that at one stage the cooperative bank would have been, but fell under the wrong kind of ownership. Unfortunately, it came out badly.
Thank you.
Okay, so I'll start with your question, because there was a time when banks, in Britain anyway, were unlimited partnerships. And that was thought to be a safer model than a limited company. And there were some spectacular busts. I'm talking back in history. There was the Bank of Ayr in about 1750 was backed by the biggest landowners in the country and still went bust. And then the City of Glasgow Bank in the 19th century, one of the biggest banks in the UK, went bust, and it again was a private partnership. Eventually, the depositors all got their money back. But it took something like 20 years in both cases for them to get their money back, because a lot of the shareholders just were bankrupted by the amount of debt that the bank had taken on, and they found that their liabilities exposed them to. So that is why, after that, banks became limited companies, and it is not a perfect system, as we found, but the regulator is supposed to ensure that banks keep a sufficient capital to absorb any losses that they make. But clearly, in 2008, we found that was not always true. Now, your point about if we make them all follow responsible banking, does that make any difference? Will that make any difference to society, really? Or will drug dealers just find a different way of financing their
I
activities.
mean, why not let the oil companies finance themselves the way the drug dealers do, and we'll be better off, right?
We could just connect the oil companies to the drug dealers, cut out the middlemen. So, I mean, on a serious point, if we force banks to, for example, follow ESG principles, is that going to make society a better place?
Well, it's not going to make it a worse place, I'm pretty
There
sure
you
of
go.
that. But it's not just banks, Isabella. I mean, when you talked about drug companies, I thought
I meant drug dealers,
okay.
not the pharmaceutical company.
But I thought you were talking about big pharma, but never. But all the same, yeah. But I mean, I think that ESG.
They're basically self-funding, is my point.
Yeah, sure. ESG is not just it's not just for banks. It's business with purpose. A purposeful business sector is what we need. It is not solely for banks, but banks are, in some ways have the commanding heights of this. They are the enabling mechanism. So I think they are particularly important. I think if you don't start at banks, you have no hope.
Yeah, and banks create, 80 or 90% of the money in circulation, central banks the rest. So we're handing them a sort of a sacred responsibility, and we're letting them lend money to whomever they like, and that's us giving them that charter. So I think we should have a say over how they allocate it's really our money in the end.
Good point. Ian,
I mean, I think with unlimited...
this gentleman question here.
Can I just talk about unlimited liability? I mean, with unlimited liability, as Andy Haldane has said, it did generate potent incentive to be prudent with depositors' money. And in The Wealth of Nations, Adam Smith said that the change in ownership structure after the Air Bank collapse could be dangerous, because the directors of joint stock companies, i.e. ones where you don't have unlimited liability, who would be managers rather of other people's money than of their own, it cannot well be expected that they should watch over it with the same anxious vigilance with which the partners of a private co-partnery frequently watch over their own. So Adam Smith was not in favour of the shift from unlimited liability to, or co-partnery as it was sometimes called, to limited liability and joint stock companies. But he's not necessarily the guru. I mean, but it's just an interesting point. And his patron, the Duke of Buccleuch, had actually lost a significant fortune, as you alluded to, in the collapse of Air Bank in 1772. So yeah, there's no, it might have been better, and maybe there were fewer bank collapses, and maybe overall the banks, and there were lots of smaller regional and local banks at the time, so maybe they were overall safer and better managed. Well, now we've got this concentration of banking. Even since the crisis, when we had 9 listed banks in the UK, we now only have 5 listed banks in the UK, because the government waived competition law to allow Lloyds to take over HBOS, etc. And Santander's hoovered up a lot of failed building societies. This concentration is probably not necessarily good for ethics, as far as I see it. It's going to lead to more abuses and people treating their customers even worse than they do currently.
Okay, 3 more questions. I think there was one here. And then the second one, the man in the white shirt. And the third one, that lady down there.
So my question's kind of related to Isabella's. So I've worked in several banks, and I developed a very simple ethical model. Kind of ethical banks are ones that actually obey the letter of the law. An actually genuine ethical one would actually obey the spirit of the law. I've not really come across any of those, because even the ones that manage to actually obey the laws and the regulations are always trying to find an angle to get around them. Do you think this emphasis on ESG actually distracts the banks from those core parts of ethical behaviour, actually obeying the clear laws and rules they should be following? Because I see some quite unethical banks making an awful lot of noise about ESG while still doing bad stuff and getting huge fines.
Okay, and that gentleman.
So my comment ties in quite nicely with the previous observation. But firstly, is there not the danger that bad banks will drive out good banks? If good banks, ethical banks are allowed to exist, the danger is that bad banks will be more profitable, at least for a while. So there'll be a kind of nasty Gresham's law in the banking sector, which raises all sorts of questions about regulation and government and such likes. And my second comment is I've worked at a bank which talked a great deal about ESG and doing the right thing, blah, 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 namely Coots. And it was a complete bloody flounder. It had no idea what it was doing. It was all a joke. Just as was observed.
You were both the Coots.
No, I wasn't obvious for a little while. Any other film?
I'm personally wondering how we think these concepts of ethical banking can be applied, and to what extent would the role of government be, and what issues might that bring about?
I didn't catch that.
I'm sorry,
Can you speak up?
we didn't catch that question.
I'm personally wondering about kind of the implications of implementing these concepts of ethical banking, and to what extent would government be involved in that, and what issues might that bring up in terms of maybe partisanship or the sovereignty of banks and so on.
Okay.
Yeah,
Well, I'd like to talk about ESG because it is like a smokescreen. It can be a total smokescreen. That's very much how Coots and RBS and NatWest have been using it. You even look at their latest annual report, which I could show you if you want, and it's all about it's the stuff that Nigel Farage hates. It's about diversity, and it's saying, aren't we great? We're pushing all the right buttons for diversity and equality. I don't know what all the different things are. There's
Governance.
No, but there's a separate thing that begins with D something something.
Diversity, inclusion, equity, inclusion.
DEI, diversity.
Equity and inclusion.
Okay, well, that. So, diversity, equity, inclusion. And the whole annual report is like this now, but the actual performance of the bank is almost secondary. And people I know in that bank were delighted when Alison Rose was sacked because she was pushing this DEI agenda, but taking her eye off the ball as far as actually properly managing the bank in an ethical way was concerned, if ethical or even unethical. So I think, it's a dangerous smokescreen, or can be a dangerous smokescreen. Beg your pardon?
It's like a virtue signal.
Yes.
Is that not to Philip's point that the world could actually end up worse? Because you said it can't be any worse if we do this. Well, that is an exact example of you've made the world significantly worse and potentially riskier as a bank through trying to appear to do good.
Yes, I think that could well be the case.
Smokescreen, you described it actually. It's a nice way of putting it. It's a good point you make as well. This just can't be that difficult, So the board need to drill down to their divisional heads that actually, in the case of Barclays, 25 billion of conduct costs over the last 10 to 15 years, that isn't good to shareholders. That needs to go down from the board to business heads. Business heads then need to drill it down to the people leading the teams. That gets fed down to people like Carol in the example that I gave, people working behind the desk in the branches. This starts at the top. This has to start at the top, and there needs to be a frank acknowledgement at board level that the responsibility of a bank, or indeed any other type of company, is bigger than just short-term profit, and that is partly that's a matter for government. It's also a matter for governance. Boards need to include people who will put this alternative view. It was very interesting when Theresa May was running to be Prime Minister. This would be just during the mid-teens, I guess. She made a speech in Birmingham with quite a radical speech saying that we needed to follow the stakeholder model, not the shareholder model, and she wanted to see workers represented on boards. There was such an incredible kickback from the city on this that actually it was quietly dropped and gently watered down so that it never appeared again. There needs to be some robustness. So start with government, board level, trickling all the way down with a robust regulatory regime around it. And actually, the smoke screen isn't good enough either.
John.
In terms of the role of government, I'd like to share a couple of observations or maybe policy proposals, ideas. When I was investigating in Iceland, I learned a secret that, I learned another I learned another thing that I never understood, and when I've given talks and things, I think a lot of people don't understand. It's like, how does so-called offshore financing work? And even the name offshore is a smokescreen, because the way it works is you can have a tax haven like the U.S. state of Delaware, where our friend Joe Biden was the senator forever. This is the world's biggest tax haven. They pioneered this model, which was then exported to the Caribbean and other places. But the way it works is like, well, stepping back, I have a niece who's 11 years old, right? If my niece would take a piece of paper and write on there, Jared Bibler owns 100,000 shares in Chesterfield Investment Company, right? And if I would take that paper into a bank in London and say, I own this company, give me an account for this company, they would laugh me out of there because it's just my niece writing on a piece of paper. But that's effectively what these offshore places do. They issue pieces of paper that say, you have a company. The problem with offshore finance is when a bank in London or Zurich or Reykjavik takes that piece of paper and lets you open an account. And I think, as an investigator, this whole system is designed for secrecy. And this is a major source of problems in the banking sector. And this is something we could quickly change if we just said, okay, new UK law, you can only open accounts for natural UK persons and natural UK companies. Problem solved, right? So that's one way that we could make a difference. And the other thing is I've been involved in Switzerland on something called micro-tax, which I think is super cool. You guys may disagree. But basically, for our country, with a 5 basis point micro-tax, so that's 0.05% on every financial transfer, but including derivatives transactions. If we would implement that, we would replace all the federal and cantonal and VAT in the whole country. So we'd get rid of all corporate income tax, all personal income tax, and all VAT, and everything would be triggered on financial flows. And this would, of course, reduce the volume of derivatives and other and would help us measure also what those things are that are happening in the system.
And what the financial services industry says, presumably, is if you do that, you'll drive the financial services industry elsewhere.
They do say that. We also tell them that of the 5 basis points, we'll give them 1 of the basis points as a fee. Yeah. And that helps them, a little bit, but you're right.
Any more questions? Yes. Where's the microphone, please? Oh, sorry, can we start? We'll start at the back and work forward, so no, okay, yep, first one.
Yeah, hello. So I'd like to know, since the Great Recession, do you think the banks are becoming more ethical, or is it kind of like the same case, or do you think that they're being more responsible, more prudent with their customers, or they're still valuing their shareholders more than the customers?
Okay, and just in front, and then just in front again.
Do banks have an obligation to allow everyone a bank account? And if not, is it the state's responsibility to pick up those who are deemed not acceptable?
And the third question.
There is a tendency generally, I think, when problems arise in a system, to look upwards for the solution and to say, why doesn't the government put in other or stronger measures to correct the problem? Earlier this evening, Ian mentioned the example of Handelsbanken and the Swedish bank. They generate no budgets at the beginning of the year. All they do is allocate an amount of capital to the branch manager based on a 3-year rolling performance, and the branch manager is king. And if the branch manager cannot generate business and retain customers, the branch closes. You do not need enormous levels of oversight, security,
and supervision from on high, generally resulting in unintended consequences, if you give proper responsibility and accountability to the person on the ground who's got control of their business. Handelsbank's model seems to be unrepeated, and it has operated this way for 30, 40 years, and as far as I'm aware, there have been no scandals. So it's more of an observation than a question. But if there is a question, the question is, why do we always look upwards for solutions when the solutions actually lie within ourselves locally?
Yeah, very interesting group of questions there. It's really about what sort of role should the state take in banking? Should we just leave banks alone to make money, which is what their shareholders invest for? Or what should the state role be in that?
Well, I think regulation is essential. But I do think what Charles says about Handelsbanken is very interesting, because actually before about 1994, what he describes of autonomous branches was more or less what RBS had. They had a model whereby the chief executive of the day, who was called Charlie Winter, prioritized three things in order. The first thing was the staff. He wanted to make sure the staff were well looked after and happy and enjoyed their jobs. Two, the second priority for RBS at that point was to look after the customers. And three, if there was anything left, he would look after the shareholders. Well, he would pay them a regular dividend, but they weren't looking for dramatic share price growth. And the branches were quasi-autonomous. So the manager of the Manchester branch or the Dundee branch or our Broth branch had almost total control over what happened. They were trusted to run their branches responsibly. They knew their customers. They knew who could repay their debts. They understood the local community. But when Mathieson came in 1990, in the early 90s, he turned that whole thing on its head. And it was as a result of Milton Friedman-esque thinking and the result of Big Bang. So suddenly the three priorities were: one, the shareholders; two, the shareholders; three, the shareholders. And everyone else, this is what people tell me who were working there at the time, whether it be the staff or the customers, they were fair game. They could be treated badly. It didn't matter. So that was a revolution in banking. And he hated these autonomous people, senior branch managers who ran a big local branch. He wanted to kick them out and emasculate them and turn the branches into sales outlets to cross-sell products to the existing customer base. And he did it very successfully, and he was the first Scottish company to make $1 billion in profit. But it was bad for the staff, and it was bad for the customers, because customers increasingly got ripped off.
I remember when I first went to the special prosecutor's office in Reykjavik, and so I started developing the big Kaupthing case in April of 2009, and I probably presented it to him a couple of months later just to show him what was coming. And there was a case called Altani, which at the time was the big case. And he said, "Is this case going to be bigger than Altani?" And I said, "Altani is just a part of this is the umbrella." And I started walking him through this share laundering, as I call it, this share laundering case, showing him the graphs and so on. And he cut me off, and he started talking to his lieutenants. And he said, "We might be talking about a violation of, it's called Almenn Hegningarlög, means the general penal code of Iceland." And their eyes lit up, because this wasn't some banking thing. This was just straight up fraud, or straight up, And so my point here is like...
Good, honest fraud.
Yeah, good, honest fraud, just straight up because we had independence in 1944 from Denmark, and this was law number, I think, 3 of 1944. It's just the general penal code of the country. He said, we have... So my point here is that I think if we go back to basics and let prosecutors and police and so on actually police old school crime and show them how to find it, that goes a long way to fixing problems in regulation.
I mean, the criminal law applies to any company, whatever they do, whether they make widgets or banks. You're saying there should be no special regulation for banks? They should just be subject to the ordinary law like everybody else?
I'm not saying that, but I'm saying if we would incentivize or encourage prosecutors to go after those things that are easy for everyone to understand, they would probably find a lot. But it seems to me that our banking regulation system has been structured in a way exactly so that that won't happen. So like in Icelandic law, for example, any case involving a financial institution has to originate in the FME, the regulator.
Right.
Even if it's just a bank doing, I guess even kidnapping or something, would have to originate at the regulator. The prosecutor, the police can't independently go in there. And I think that's a huge, but I think that's actually by design. Right?
So the regulator is really a protector of the bank. Yeah.
Philip.
Just to pick up the three questions that were asked, just a line on each. You asked about the direction. Is it better or is it worse? I think the most egregious examples of bad behaviour have been ironed out. Before the banking crisis, if you went into any of the back offices behind a branch in pretty much any of the high street banks, there'd be a piece of paper on the wall, and the names would be down that way. Across the top would be the products, and you had to have a tick by the box to show that you, Ray Perman, had sold a mortgage this month, tick. And if you hadn't, there'd be pressure at the end. So that has stopped now. That has been replaced by a different set of metrics which are to do with customer satisfaction. Some improvement there. However, I'm still surprised that bad behaviour continues. There was a big scandal, the payment protection scandal, where individuals were being sold insurance policies should they lose their employment. But the policies would exclude things like if you've got a bad back, or they were sold to self-employed people, and there were exclusions in there. That stopped. But actually what is still going on now, it seems, according to the news that's coming out now, is that expensive loans are being sold to people wanting to borrow money for a car, and there seems to be some kind of collusion between the banks and the dealers, and that seems to have been going on until very recently. So the most egregious examples have gone, but I think there's still stuff going on under the surface. Then there was a question about should there be an obligation on banks to provide universal service to the unbanked?
Yes, we forgot that one.
I mean, I think actually, to be honest, I think, if you're a bank and you expect a state bailout when things go wrong, as always happens, then there's an obligation as well, and that should be part of it. The Handelsbank is a bank that is very much to be admired, and you described the model extremely well. Whether it's scalable for the kind of retail banks, and you used the example of Ian of RBS, I think that will be hard to replicate in the big scale banking model for the big four. But I think it's an absolutely great worked example, really great.
Okay, three more questions. Let me get some more questions in. Three more questions, please.
On motor policies, it's called PPI on wheels.
Is it?
Yes. PPI costs 50 billion.
Hang on, Ian. Let's have another question, please.
Seriously, it could.
Thank you. Very interesting session. So we were talking this morning in a different session about the energy transition and how complex that is. And we've heard this afternoon now that to an extent banks should not help companies that are polluting the planet. So is that going to give too much power to the banks? Is that going to be a thing that is even feasible to aid a sustainable energy transition, or is that going to muddle the waters even more? Thank you.
Was there two more questions, one here and one here, and that would be, I think, take us up to time, but if we could do that, please.
Hi. I guess my question is, have you ever thought about forming your own bank? And could you have a concept, I mean, or is there a concept where you can have a bank that's non-for-profit? Yeah.
I'm just interested in how you might marry the universal service to the principles of ESG, where you're going to be choosing who you'd offer your services to.
Who wants to go first on those three very interesting questions? Jared, let me
I'll
give
take
you
the non-profit bank. I actually, I have my own company, a consulting firm, and my own private accounts. It's with what's called a Genossenschaft, which is a community bank in Switzerland. It belongs to the town where I used to live, and it's non-profit. It's just it's a mutual organization. But I think also in the U.S. context, I don't know about the U.K., but you have savings unions and things like this.
We have credit unions here.
Yep. So I think those are brilliant, actually, and it's the reason I'm in one. But
And have you anything to say on the other questions? More power? Are we giving too much power to banks? And the universal service?
in terms of too much power, I think that's an excellent question. I always fall back on my same tropes, sorry, but I think we can give them that power, but we have to get the regulation right, which we just absolutely do not have now. So whatever way we do that, and I think incentives for regulators to break big cases, so monetary incentives for regulators, and also empowerment of, like I said, empowerment of prosecutors to go after old school crimes, neither of which is happening today.
Yeah. Good. Ian, do you?
I mean, I've never thought of setting up a bank, but there is something called the Bank of Dave. I don't know if you've heard of that. It's been heavily promoted. There's been quite a lot of TV programs or Netflix shows about the Bank of Dave. But he is, pursuing a model which is not for profit. It's for the benefit of the community. I think building societies are generally more likely to be caring for their customers than listed banks. So all three of my children bank with the Nationwide, and other people I've spoken to bank with Nationwide, which is one of the few surviving building societies. And generally they seem to get a reasonably good service. So what were the other questions?
But are we, through ESG and so on, handing more power to banks?
About who they lend to?
And should banks have this universal obligation?
To offer bank accounts to anybody? Yeah, I agree with Philip. I think considering we are backstopping them in the event of their failure, we essentially as a country, as an economy, are saying, we'll rescue you if you fail. Yes, they have to have more obligations to perform public good and ensure they do offer basic bank accounts to anyone who wants one.
Philip, and specifically the question was, how does that fit with ESG, wasn't it? And I think the definition of ESG needs to be a very broad one. It's not just about the green economy. It's about treating people the right way. It's about having responsibilities to society at large, to the wider economy. And that isn't to say that every bank, you've got to give a bank account to every person that walks in off the street. There clearly needs to be some kind of credit testing. But in the event that an individual falls through everywhere, there needs to be a safety net. There is a kind of safety net at the moment, a state-run safety net. There's the potential of the post office, but I still hear too many examples of people that just have to have a bank account just basically to live, and that find it difficult to navigate the system. But there are some universal obligations in place. But you've got to consider ESG. It's more than just the box ticking, green stuff, diversity stuff. All of these things are important, but it's got to be a redefinition of what business and what banking is about. But thank you, good question.
Thank you. We're out of time. I'm not convinced we've answered the question of what actually is an ethical bank, what does it look like? But hopefully we've answered the question, what does it not look like? And that you've enjoyed the discussion. So thank you very much for coming along. Thank you for your participation. Can I, on your behalf, thank the organisers here, the excellent organisation, and my fellow panel members. And just remember, we are 4 struggling, penniless authors. So if you're looking for something to read, there are plenty of books on sale outside. So thank you very much.